Preparing for a financial analyst at American Water interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at American Water? I am attracted to American Water because it combines rigorous financial analysis with an essential public service. Water infrastructure requires disciplined capital allocation, regulatory awareness, and long-term planning, which are areas I find motivating. My experience with financial modeling, variance analysis, and communicating findings to non-finance partners would translate well to the role. I also value the company's scale and operational complexity. I want to help management make decisions that strengthen returns while supporting reliable, affordable water service. While answering, connect your analytical skills to American Water's essential service mission, regulated utility model, infrastructure investment needs, and customer impact. Demonstrate research into the company and explain why the role fits your long-term goals. Question 2. What do you know about American Water's business model? American Water primarily provides water and wastewater services through regulated operations, while also participating in market-based businesses such as services for municipalities and industrial customers. Regulated revenues depend on approved rates, customer usage, and regulatory decisions, while costs include treatment, labor, energy, maintenance, and infrastructure investment. The business is relatively defensive because customers need water in all economic environments. However, analysts must understand regulation, affordability, conservation trends, and capital intensity when evaluating performance. Make sure to cover regulated and market-based operations, water and wastewater services, customer revenue, rate cases, capital investment, operating costs, and the distinction between financial performance and public service obligations. Question 3. How would you analyze American Water's revenue performance? I would decompose revenue into customer count, usage volume, approved rate changes, weather effects, mix, and acquisitions or divestitures. I would compare results with budget, prior year, and management guidance, then distinguish recurring drivers from temporary items. For example, higher revenue could reflect a rate increase rather than stronger demand. I would reconcile operational metrics to reported revenue and discuss anomalies with business leaders. That approach produces a more useful forecast than simply extrapolating the latest quarter. In your answer, talk about separating price, volume, customer growth, weather, mix, acquisitions, and regulatory effects. Mention comparing actuals with budget, prior periods, and guidance, then investigating unusual movements with operating teams. Question 4. What is a rate case, and why is it important to a water utility? A rate case is a formal request for regulators to approve customer rates that recover prudent operating costs and provide an allowed return on invested capital. The utility presents its rate base, forecast expenses, capital plan, and required revenue. Regulators evaluate those claims while considering service quality and affordability. Rate cases matter because approved rates determine future revenue and cash recovery. Timing is critical. A utility may fund infrastructure well before rates reflect the associated investment. Be sure to mention the regulatory approval process, revenue requirement, rate base, allowed return, operating expenses, capital spending, customer affordability, and the timing risk between investment and recovery. Question 5. Explain rate base and how it affects American Water's earnings. Rate base generally represents the net plant and other qualifying investments that regulators allow a utility to use in calculating customer rates. When American Water makes prudent infrastructure investments, those assets can enter rate base after approval and begin earning an allowed return, alongside depreciation recovery. Rate base is reduced by depreciation and retirements. Therefore, sustained investment can support long-term earnings growth, but only if projects are needed, approved, and recovered through timely regulatory mechanisms. Focus on the utility's net invested assets, prudently incurred capital, depreciation, accumulated depreciation, regulatory approval, allowed return, and the link between rate base growth, revenue recovery, and earnings. Question 6. How would you evaluate a capital expenditure proposal for a water utility? I would first classify the project as compliance, safety, reliability, growth, or discretionary. Then I would assess the business case using project cost, timing, useful life, operating savings, avoided failures, customer impact, and potential regulatory recovery. I would calculate relevant return metrics where appropriate, but not force every project into a simple NPV framework because compliance and safety can be mandatory. Finally, I would run sensitivities for construction delays, cost inflation, financing rates, and delayed rate recovery. Make sure to cover safety, compliance, reliability, customer demand, project economics, timing, construction risk, regulatory recovery, operating savings, and sensitivity analysis around cost overruns and delays. Question 7. How do depreciation and capital expenditures affect a regulated utility's financial statements? Capital expenditures increase PP&E on the balance sheet and reduce cash flow from investing activities. They do not immediately reduce earnings unless expensed under accounting rules. Depreciation then lowers operating income and PP&E over the asset's useful life, while appearing as a non-cash add-back in operating cash flow. For a regulated utility, depreciation may also be recovered through customer rates. The key analytical point is that growing CapEx can pressure near-term cash flow even while supporting future rate base and earnings. In your answer, connect capital expenditures to PP&E and cash flow, depreciation to earnings and accumulated depreciation, and explain that depreciation is non-cash but can support rate recovery through regulatory mechanisms. Question 8. Walk me through a three-statement impact of issuing debt to fund infrastructure. At issuance, debt and cash increase on the balance sheet, while financing cash flow is positive. When the proceeds fund construction, cash declines and PP&E increases, creating an investing cash outflow. Once the debt is outstanding, interest expense reduces pre-tax income and net income, while interest paid reduces operating or financing cash flow depending on presentation. Principal repayment reduces debt and cash without affecting net income. I would also monitor leverage, coverage ratios, and rate recovery from the funded assets. While answering, cover the initial balance sheet and cash flow entries, later interest expense, principal repayment, debt ratios, tax effects, and the possibility of regulatory recovery from assets funded by the borrowing. Question 9. Which financial metrics would you monitor for American Water? I would monitor revenue and customer growth, operating income, EPS, operating cash flow, free cash flow, capital expenditures, and rate base growth. Because American Water is capital intensive, I would also track debt to EBITDA, funds from operations to debt, and interest coverage. Operational indicators such as water usage, service reliability, leakage, and regulatory outcomes provide important context. I would not judge performance from EPS alone, because investment can depress near-term cash flow while supporting durable regulated earnings. Discuss revenue growth, operating income, EPS, operating cash flow, free cash flow, capital expenditures, rate base growth, leverage, interest coverage, customer growth, and regulatory outcomes rather than relying on one metric. Question 10. What is the difference between EBITDA, operating cash flow, and free cash flow? EBITDA measures earnings before interest, taxes, depreciation, and amortization, so it is an operating performance proxy rather than cash flow. Operating cash flow starts with net income and adjusts for non-cash items and working capital movements. Free cash flow typically equals operating cash flow minus capital expenditures. For American Water, free cash flow may remain pressured during heavy infrastructure investment even when EBITDA grows. I would therefore analyze all three measures together, alongside regulatory recovery and financing needs. Be sure to define each measure, distinguish earnings from cash generation, Explain the treatment of working capital and capital expenditures, and note why free cash flow requires special interpretation for infrastructure-heavy utilities. Question 11. How would higher interest rates affect American Water? Higher rates would increase the cost of refinancing and new debt, raising interest expense and potentially reducing EPS and cash available for investment. They could also lower valuation multiples across the utility sector because investors compare yields and discount rates. For American Water, the impact depends on debt maturity timing, fixed versus variable exposure, and regulatory recovery. Higher rates may eventually influence allowed returns, but there can be a lag. I would model several rate scenarios and assess covenant and coverage effects. In your answer, cover refinancing costs, interest expense, valuation multiples, customer affordability, debt capacity, project economics, and the potential timing lag before regulators allow recovery of higher financing costs. Question 12. How would you forecast American Water's free cash flow? I would forecast operating cash flow from revenue, operating expenses, working capital, taxes, and interest, then subtract planned capital expenditures and other investing requirements. I would build CapEx from project-level schedules, separating compliance, maintenance, growth, and discretionary spending. I would also model acquisition activity, rate case timing, regulatory assets, and working capital seasonality. Finally, I would create base, upside, and downside cases because construction costs, approvals, weather, and customer usage can materially change cash generation. Focus on operating income or net income, non-cash adjustments, working capital, capital expenditures, taxes, interest, regulatory timing, acquisitions, and scenario analysis for infrastructure spending and cash recovery. Question 13. Describe how you would perform a budget versus actual variance analysis. I would begin by comparing actual results with budget at the business unit and account level, using materiality thresholds to prioritize review. For revenue, I would separate volume, customer, rate, and mix effects. For expenses, I would analyze labor, energy, chemicals, maintenance, timing, and one-time items. I would discuss significant variances with operating owners, document root causes, and determine whether they are temporary or structural. The final output should explain implications for the full-year forecast and recommend actions. Mention materiality thresholds, revenue and expense drivers, favorable versus unfavorable classification, volume price rate decomposition, root cause investigation, forecast updates, and clear communication of actionable conclusions. Question 14. How would you build a financial model for American Water? I would structure the model around operational drivers rather than applying broad percentage growth assumptions. Revenue would reflect customers, usage, approved rates, and acquisitions. Expenses would include labor, energy, treatment, maintenance, and corporate costs. I would separately model CapEx, depreciation, rate base, debt issuance, interest, and taxes, then link the income statement, balance sheet, and cash flow statement. I would add scenario toggles, error checks, historical reconciliation, and clear assumption labels so the model is auditable. Be sure to mention operating drivers, rate cases, customer and usage assumptions, CapEx, depreciation, debt, interest, the three statements, scenario controls, checks, and transparent documentation. Question 15. What risks are most important when analyzing American Water? I would focus on regulatory disallowance or delayed recovery, environmental and water quality requirements, infrastructure failures, cybersecurity, severe weather, drought, inflation, labor availability, and interest rate risk. Some risks affect costs directly, while others damage reliability, reputation, or the regulatory relationship. I would assess each risk by probability, financial exposure, mitigation, and timing. For example, construction inflation may reduce project returns, while a compliance requirement may increase CapEx but also support necessary rate recovery. Discuss regulatory disallowance, environmental compliance, infrastructure failure, cybersecurity, weather, water quality, labor, inflation, interest rates, drought, customer affordability, and the need to quantify probability and financial impact. Question 16. How would you value a regulated water utility? I would use a DCF, public company multiples, and dividend-based analysis, then cross-check the results. The DCF should reflect customer and rate growth, operating margins, CapEx, regulatory recovery, taxes, financing, and a utility-appropriate discount rate. Trading multiples such as EV to EBITDA and price to earnings should be compared with similar regulated utilities, adjusting for growth, leverage, and allowed returns. I would also examine price to rate base context because regulated assets and earning power are central to valuation. In your answer, compare DCF, comparable companies, precedent transactions, dividend-based methods, regulated growth, allowed returns, leverage, rate base growth, and the limitations of applying standard corporate valuation alone. Question 17. How do you ensure accuracy when working with large financial datasets? I start by confirming the source, reporting period, grain, and definition of every field. I reconcile extracted totals to the general ledger or approved reporting package, use control totals, and test a sample of records. In Excel or SQL, I build duplicate, missing value, sign, and reasonableness checks, then investigate exceptions rather than manually overriding them. I maintain documented assumptions and version control, and I ask for an independent review before distributing analysis that informs management decisions. Mention source reconciliation, control totals, consistent definitions, automated checks, exception reporting, version control, documentation, review procedures, and investigating differences before presenting conclusions. Question 18. Tell me about a time you found an error in a financial report. In a monthly reporting file, I noticed that maintenance expense was unusually low compared with both budget and the prior year. I traced the variance to a mapping change that excluded one operating region from the report. I reconciled the corrected data to the ledger, quantified the impact, and informed my manager before distribution. We corrected the report and added a region count check to the process. The experience reinforced that analytical judgment and control design are equally important. Use a concise star. Question 19. How would you explain a complex financial result to an operations manager? I would begin with the headline and its business implication, then use a simple driver bridge. For example, I might explain that operating costs exceeded budget because energy prices and treatment volumes were higher, not because of uncontrolled labor spending. I would quantify each factor, distinguish controllable from external items, and explain the forecast impact. I would avoid accounting jargon, invite the manager's operational perspective, and end with a specific action or follow-up question. Focus on starting with the decision needed, using plain language, connecting financial results to operational drivers, avoiding unnecessary jargon, using a concise bridge, and confirming understanding through questions. Question 20. What would you do if a senior stakeholder challenged your forecast assumptions? I would first understand which assumption the stakeholder challenges and why, without becoming defensive. I would review the supporting data, compare it with operational evidence and historical trends, and test an alternative case. If the new information is credible, I would update the model and document the change. If not, I would explain my rationale respectfully and show the sensitivity. My goal is a transparent, decision-useful forecast, not protecting a particular number or winning an argument. Be sure to mention listening carefully, separating facts from judgment, reviewing source data, testing alternative scenarios, documenting changes, maintaining independence, and escalating only when assumptions materially affect decisions. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.